Let me ask you something. What if I told you that mortgage rates just made a move that could affect your next home purchase or refinance? Well, stick around because this week's mortgage interest rate update has a few surprises that you will want to know about. And here's the kicker. If you're thinking about buying a home or refinancing, the next few days could either save you thousands or cost you big. Well, let's go ahead. Let's break it down. Let's start with Monday. Mortgage lenders didn't update their rates because the bond market was closed for President's Day. When the bond market takes a break, the rest of the world keeps trading, which means the U.S. markets has to catch up when it reopens. And catch up it did. On Tuesday and Wednesday, mortgage rates jumped up a bit. But Tuesday afternoon, we saw rates right back to where we saw last Thursday, wiping out the last Friday's improvements. But here's the silver lining. Those Thursday's rates were already some of the lowest we've seen in almost 2 months. So we're still in a pretty good spot. Now, the bond market itself was unusually quiet on Tuesday, only about half of the usual trading activity, which is pretty normal after a long weekend, especially with no big economic news to stir things up. So what did happen, though, was European markets pushed bond yields higher overnight, and the U.S. market followed that trend. In simple terms, when the bond markets go up, mortgage rates usually follow. Think of it like this. Bonds are like a seesaw. When the bond prices go down, the interest rates attached to them go up, which pushes mortgage interest rates higher. By the end of the day, bond yields settled back into their usual range, which was between 4.5 and 4.57, the same range we've been stuck in for the past few weeks. But here's where things get interesting. On Wednesday, the Federal Reserve released their minutes from their last meeting. Now, these reports usually don't shake things up, but this time there was a small detail that made traders sit up and pay attention. And that was that the Fed hinted that they might slow down how quickly they're reducing their balance sheet. So think of it this way. The balance sheet is like a pool of money the Fed uses to keep the economy stable. If they stop draining the pool, it means more money stays in the system, making it cheaper to borrow. That move would boost bond prices, which tends to lower mortgage interest rates. The drop was tiny, about 0.01%, so most lenders didn't even bother updating their rate sheets. But fast forward to Friday and things got more exciting. The S&P Services PMI, which tracks how well the service sector is doing, dropped sharply. That's basically a red flag that the economy might be slowing down. And guess what happens when the economy shows signs of weakness? Investors get nervous and place their money into safer places like bonds. When more people buy bonds, bond prices go up and mortgage rates go down. But that's not all. The stock market also took a nosedive, and when the stocks fall hard, investors often rush into bonds as a safe haven. The result? Mortgage-backed securities, MBS, which are bundles of home loans sold to investors, gained value, and mortgage rates improved even more. To break it down further, think of it like this. When the economy looks shaky, people look for safety. Bonds are considered safe. So when money flows into bonds, their prices rise and the interest rates tied to them falls, bringing mortgage rates down with it. So here's the bottom line. Mortgage interest rates are now near the best level since early December. Back then, the average 30-year fixed rate was sitting above 7%. We dipped into the high 6% range on February 5th, tested those waters again last Friday, and now we're ending this week in roughly the same place. If bond markets stay steady, some lenders might offer slightly better rates on Monday. But don't get comfortable. If any big news hits over the weekend, things could flip fast. And here's a question for you. If you knew rates could drop into the low 6 range next week, would you jump into the market or would you hold off? Let me know in the comments because this could be the window you've been waiting for. And speaking of next week, here's something you really want to watch out for. And that is the PCE report that's coming out next Friday. That personal consumption expenditures report, the Fed's preferred measure of inflation, is showing some interesting possible things. If inflation were to heat up, rates could jump. However, if it shows cooling, we might also see another drop in the mortgage interest rates. This report has the power to shake things up, so keep it on your radar. And here's one more thing. While I'm not a lender myself, I do work with some incredible mortgage professionals across multiple states, including California, Oregon, Washington, Florida, here at home in Idaho, Tennessee, Arizona, and Nevada. If you're in the greater Boise area, including the Treasure Valley, and need a trusted lender referral, please reach out. I'm always happy to connect you with the right people. So that's your mortgage interest rate update for the week. And if you found this information helpful, please hit that like button, hit the subscribe button below, and ring the notification bell so that you don't miss the next update. And here's my question for you. If mortgage interest rates dropped into the low 6 range, would that make you jump back into the housing market? Drop your thoughts in the comments. I'd love to hear what you think, especially in the real estate space. Thanks for watching. God bless. And I look forward to the day that I call you my neighbor.